Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Our top stories today: gold prices extending losses in the Asia-Pacific session following the biggest drop in 5 years. Investors are locking in gains after this unprecedented rally.
President Trump reiterating that he's hopeful of a deal with China, but adding that a meeting with his counterpart Xi Jinping may not happen at all.
And Pop Mart share is going to be in focus this hour after sales surge on the back of Labubu mania, but investors now worry whether the company can actually keep up. Good morning. Going into the open today, we're looking at one specific sector. We're looking at precious metals and its different derivatives and proxies across the region. As you can see, 4,000 looks to be very much realistically. We could see a drop below that on spot gold. We're seeing a continuation, in fact, an acceleration of the losses going into the Asia-Pacific session following really what were big losses already in the overnight session. So this is what we're doing as far as some of the spot prices are concerned. Some of the proxies on your screens are coming up. Aussie miners and ETF, of course. You're looking at also, of course, the Thai baht as one of the sort of currency proxies of that trade. Substantial losses that we're seeing in the equity complex tied to precious metals today. More on this in a moment. Asia Pacific is doing this. You have Taiwan coming online. India, by the way, is shut today. You have the dollar and the U.S. benchmark right now, or at least the futures of that as well coming through. And going into the open today, A50 futures, just keep in mind, of course, certainly within sectors, we're looking at precious metals. We're looking at Pop Mart, for example. We talked about that. Some of the gold plays like Labubu Gold, Chartered, which have done substantially well. And within the Chinese equity complex, we're looking at this A-share market rally, which up until this morning actually meant that the Shanghai comp could have tested multi-year high. It doesn't look like we'll see that happen today, looking at how strong this downdraft is across equity futures. The 30-year yield is now trading at about a 1-month low. So that's a separate conversation. We'll get to all of that in a moment, of course.
Yeah, and this on the backdrop of what Goldman Sachs is saying, right? That, Chinese stocks could see about 30% upside here through 2027, right? If you start to see a more sustained and less volatile sort of uptrend. So certainly that's one thing in question here today, given where futures are indicated. And we talked about the gold and silver stocks sort of, the filter through from gold prices and that route that we continue to see here in the Asia session, right? 5 standard deviation move in the gold price
That's
overnight.
wild.
So, of course, we're watching Labubu Gold. In the face of also they're doing a share placement as well. Chow Tai Fook watching Alibaba, given that pop we saw here, giving some news, local news reporting about AI and the like, and Pop Mart as well coming out with those sales numbers, still looking pretty robust here as well. That A-share market rallies we're certainly watching out for in terms of sectors, sports, and vaccines are in focus. There has been a bit of an influenza outbreak as well in China that we're focusing on here today. And some earnings like China Unicom we're focusing on. That CGB rally, as Dave mentioned here. And of course, we are in the middle of the 4th plenum as well.
Yeah, okay. Lots to unpack going into the session today. We're starting things off with a closer look of what looks to be still, we're in the midst of this sell-off across the precious metal space. And joining us now is the Global Head of Commodities Research at Standard Chartered, Suki Cooper, joining us from New York. Suki, good morning from the Asia Pacific. It must have been an extremely busy Tuesday for you, so thank you so much for taking the time. What do you think happened? Let's start simple. What do you think happened overnight?
There's a combination of factors here. From a technical standpoint, we can see that prices have been trading in overbought territory since the start of September. But equally, the rally that has been fast and furious. It's been quite a different momentum that we've seen over this last leg higher from around about 3,500 to when prices breached 4,000. It wasn't the same cadence of demand that we had seen previously, and the universe of investors in the gold space had expanded quite rapidly, and we were seeing a rapid accumulation in terms of ETP flows. So gold hadn't really had a chance to test that floor. And then coupled with that technical overbought territory, we'd also, we were ahead of the Diwali-related buying as well, and that was impacting both gold and silver. Now Diwali took place on Monday. We're potentially likely to see a slowdown in some of that appetite as well. So it's likely a combination of factors, and coupled with that, we've also saw some positive rhetoric around US-China trade talks. So it's a combination of factors, but we think technical selling has been the main culprit behind the downward leg that we've seen.
Yeah, I really haven't seen moves like this ever, it seems, Suki. I'm just wondering, what are you looking at in terms of levels right now? What's considered a healthy sort of retreat or pullback here? And what's resistance, what's support?
That's a great way of looking at this sell-off. We are forecasting a quarterly average of $4,000 per ounce for the fourth quarter. We do expect gold to regain its upward momentum going into 2026, and we're expecting further highs next year. So we're expecting Q1 prices to average $4,200, but for the year as a whole, $4,488 per ounce. But in Q4, we think that currently we are seeing something of a healthy correction. We wouldn't be surprised if we see prices dipping below $4,000 per ounce. From a technical standpoint, I think that provides the best guidance in terms of what sorts of levels we could be looking at in the near term. And 3,900 is the next technical support. And then beyond that, we look at levels around about 3,700 in terms of where that support could come. I would say that normally in the gold space, we look to the physical market to set that downward support, but we haven't really had a chance to test that floor. The physical flows that we saw in terms of official sector demand, in terms of demand from China and India, haven't really been tested on the downside. So that will be crucial in terms of where that demand materializes. India's market typically would be still responsive if prices were high but stable. But if they're high and volatile, then we tend to see the market stepping away.
Yeah, so Suki, if you could talk more about specifically what you're tracking at this point in the physical market, since you mentioned that might just be perhaps the best leading indicator right now of where we go short term.
So we think the crucial factor here is really around ETF demand, ETP holdings. On a global basis, holdings are now have reached 3,900. At its peak, holdings were 3,920. So we're very, very close to that all-time high in tonnage levels. And that peak was set in October 2020. In terms of dollars, AUM has already been scaling record highs for most of this year. But the accumulation this month has already reached 50 tons. And most of that inflow has arisen across the US and across European products. So one of the factors that we are tracking now that we can track on a daily basis is whether we see net redemptions emerging across the ETP demand. That's been the biggest driver of the leg most recently. And we haven't had the tactical data in terms of the CFTC positioning given the US government shutdown, but we can see from the open interest data that the spikes have been accompanied with higher prices, and that suggests that we've seen short-term positioning scaling higher as well. So it's a combination of checking whether this investor demand that's been accumulated recently, whether these new market participants are much more resilient, whether they tend to be longer-term holders, or whether we're seeing much more nimble positioning and fragile positioning across the recent accumulation. So the biggest factor to track would be ETP flows. And then beyond that, we would be checking India's premium or discount, and then China's market as well in terms of whether that continues to trade at a discount.
Yeah, we mentioned ETFs, we mentioned physical demand. What about when it comes to gold's correlations with things like the US dollar, real yields? Even stock markets, which I think it's gone from a negative correlation to a positive one. How closely are you looking at these relationships now, too?
This has been a fantastic or a fascinating driver even over the past few years. We saw a lot of these traditional relationships breaking down since 2022 when official sector buying changed the dynamic of the market, and we saw that floor being raised on the back of physical demand. But we noticed in July that a lot of these relationships started to turn, and most importantly, gold's correlation with real yields started to become strong again and started to become relevant again. And that's also coincides when the market was starting to price in the scope for rate expectation cuts across the US. We're forecasting 2 more cuts for this year, and we think that those help to provide some of the upside momentum in the gold price, but we're expecting the Fed to remain on hold going into 2026. So we think that these key correlations are becoming important again. The correlation with the dollar has turned much more relevant over the past I'd say 6 to 9 months, that's become an important driver as well. And that's been important, especially around concerns around fiat currency debasement. So some of these macro drivers, I think, are going to be key to track in the near term.
Suki, thank you so much for coming online and telling us what's going on here. Suki Cooper, Global Head of Commodities Research at Standard Chartered Bank. Part of this discussion of why maybe we are seeing that drop in gold prices really has, as what Suki mentioned, how we're seeing tensions between U.S. and China, which have cooled down of late, right? Well, President Trump added a little bit more to that discussion, right? Saying an upcoming meeting with Xi Jinping would yield a, quote, good deal on trade, while also conceding that the highly anticipated talks may not happen. Trump also says that without a deal, Chinese imports will face a tariff of about 155% as of November 1st.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years.
And Min Min is in Shanghai for us this morning. Min Min, certainly positive tones, or at least setting the stage there for hopefully successful talks there out of Donald Trump. Min Min.
Yes, but also a little bit of a mixed messaging here. And I'm not sure how much attention we should pay to what President Trump says on a daily basis because of the flip-flopping we've been hearing over the days. I mean, right now he's saying he's threatening these 155% tariffs on China come November 1st. But at the same time, he's saying they're going to have very successful talks. A few days ago, he was saying he has very good relations with President Xi. But he was also warning that these high tariffs are not going to be sustainable for China and that China would suffer without doing business with the U.S. So I guess we'll have to see. He also mentioned that it's possible the talks may not happen if, quote, somebody doesn't want to meet, if it's going to be nasty. And it seems like he's signaling here that he is the one that wants the meeting to happen. Any cancellation will be the result of the Chinese. But so far, we haven't heard anything from the Chinese side. All signs are pointing to very concrete steps being taken to lay the groundwork for this talk, because Scott Bessent is meeting with his Chinese counterpart this weekend to de-escalate trade tensions. The two men already had a virtual call on Friday, which the Chinese side said was frank and constructive. So yes, very likely we're going to see this meeting happen in 2 weeks' time. What's the outcome of that? Still anyone's guess at this point.
Yeah, obviously everyone's kind of gaming scenarios now. What's the best case scenario? What's the worst? What are some of the scenarios you're looking at?
Well, if you go down the wish list that China has, obviously it will want access to chips, right? Not just the high bandwidth memory chips, but the highest end semiconductors from the US as well. And there's reason to believe that maybe President Trump might be more amenable to that than his predecessor Biden, given how Trump has shown a willingness to cut deals with companies like Nvidia, right? Giving them a chance to sell to China for in exchange for a piece of their revenue. But also there's a question of, some analysts here are saying that China needs semiconductors from the US less than the US needs rare earths from China. And some are saying that President Xi might be more willing to stand his ground and walk away from a deal if his conditions are not met. But if you go down the list again, aside from chips, there's also, of course, tariffs, right? China will likely want its tariffs to be on par with other countries. That means removal of the fentanyl-related tariffs, which means that perhaps China will have to make some show of pledging more actions to stem the flow of fentanyl ingredients to the US. And in exchange, the US wants assurance that those rare earth shipments are going to come on time. Now, this is something that China has been using as leverage, but at the same time, we saw how China has been concerned about the spillover effect on the rest of the world, because the Chinese Commerce Ministry yesterday had convened a meeting with an unusually large group of businesses, 170 foreign businesses and chambers in Beijing, reassuring them that these rare earth controls are not meant to disrupt normal trade, and really that this is targeting the US in the context of this trade war.
Min Min, thank you. Our China correspondent Min Min Lo there joining us out of our Shanghai studios this morning. Now, in the next hour, we'll be speaking with Eurasia Group's Dan Wang on the potential Trump-Xi talks and our expectations when it comes to the fourth plenum currently underway in Beijing.
Yep. And just coming down to the open of trade, currently underway here in Hong Kong is an intense northeast monsoon, so which is why we're looking at some fairly gray skies, a bit coldish. Relatively coldish this morning, sort of qualified that. 0.3% futures are pointing down. Gold is continuing to see some pressure. More in a moment on markets. The opening bell 15 minutes away. This is the China Show.
All right, we're taking a look when it comes to your futures here this morning, and we are slightly to the downside here. So we are seeing, when it comes to stocks, a little bit of a cooling in the temperatures there, given just the record rallies we've seen yesterday, where it was, Taiwan, Japan, Korea, Asia overall also reached record highs yesterday as well. So does this gold drop signal anything when it comes to risk assets here? Of course, and that's one thing to watch. Of course, 712 for dollar China this morning.
Yeah, does the precious metals route remain just there, right? Ring-fenced in a somewhat of a vacuum, or does it send a signal of maybe other things perhaps breaking ahead? Overnight, this is the equity complex. In terms of factors, the biggest factor moves in the U.S. session overnight, as you can see, right? So the question we're asking is momentum actually cracking, and does that signal perhaps more pain ahead, broadly speaking, for core assets? Joining us here on set is George Efstathopoulos, portfolio manager at Fidelity International. How are you looking at this gold? This precious metal sell-off, is that just there, or do you see this as perhaps being indicative of something broader?
Morning, David. Morning, Yvonne. Great to be on the show. So first of all, there's been a pretty decent correction sort of overnight, and also this morning it continues. I've seen kind of the headline. It's the biggest drop in 10 years, and I think context matters here, because you go back a week or a little bit more than a week, and it's pretty much sort of flat on a week basis, despite this sort of huge drop on a decade basis. So that's it's important to put things in context, and it's important to remember sort of why has gold been rallying the way it has been rallying, and there's been several factors. We have sort of more medium to long-term factors that I think are still here to stay, and there's been some more short-terms that perhaps are dissipating. The more long-term are we have the Fed is easing. That's usually good, a positive thing for gold. We have inflation. Again, that's another sort of positive thing for gold. We have had a dollar weakness for most of the year. Obviously, it's been more sort of sideways going for the past few months. But we do think that the dollar weakness is probably going to be sort of more structural in nature. And there's also been concerns around central bank independence. What if yield curve control happens at some point? These are all factors that have been very supportive of gold, and I expect to be supportive of gold on an ongoing basis. But there's been other factors as well that have been driving this exponential increase in gold the past few weeks. It's been the shutdown, and it's also been the geopolitics between US and China. Some of these now seem to be getting a little bit better. The news flow that we're seeing has been a little bit better, and as a result, it makes sense for gold to consolidate somewhat. But I personally would think of this as an opportunity to buy once we see some stabilization there. What does this mean for other assets? For me, the important thing is to always remember that the Fed is easing, and the Fed is easing in a cyclical reacceleration. And what that means is probably this is positive backdrop for risk assets, even if they consolidate somewhat in the short term.
Okay, so maybe right now it's still somewhat of, as Dave mentioned, right? You're starting to see momentum sort of cracking here, whether it's crypto, we've seen little flare-ups here and there on that. The gold is next. So can I keep a pretty big, in terms of stock exposure, should I be able to continue on with stocks for some time then?
Yep, we are on sort of cautiously risk-on mode on our end. We would be buying weakness. We're towards the end of the poor seasonality with October. Just over a week to go. Typically, kind of the very end of the year tends to be sort of a bit more positive. And again, it's about the Fed is easing. And let's not also forget what's coming up next year. We have fiscal spending. We have the One Big Beautiful Bill. The Fed is easing at a time when, again, we're seeing cyclical reacceleration, and we're going to have fiscal stimulus coming from the U.S. We're going to have even more sort of excess capacity coming from the banks that will be able, that will help sort of reaccelerate the lending cycle in the U.S. And it's not just about the U.S. We're seeing fiscal stimulus pretty much in most places. You're seeing fiscal stimulus coming from Germany, a place where it has been, the most, the anchor point. It's been the most conservative country in the world for the past 20, 30 years. We've seen more fiscal stimulus coming from Japan, especially now as the politics seem to have stabilized somewhat. We had some stimulus coming from China, but we expect more to come, especially as the fourth plenum is on the way. So we're seeing globally fiscal stimulus that can help support global consumption.
And within the equity complex, where do you think the best value is at this point?
Well, some of the themes that we're looking at, sort of a couple of them. So one of them is what I kind of refer to as the era of financials. Essentially, if we look at financials, there's been, since the global financial crisis, 15 years now, financials has probably been one of the worst performing sectors. It has changed the past couple of years, and it has changed for some good reasons. And this is where I think all the stars are aligned when it comes to financials.
Okay.
What are these stars? Two of them are cyclical, two of them are structural. The structural ones are essentially deregulation. We're seeing deregulation in the US. We're even seeing deregulation in places like Europe. For a long time, in Europe, it's been regulation. We're seeing sort of a shift from that. So, deregulation is one thing. Cash rates. No more ZIRP, no more NIRP. These terms are sort of long forgotten now. Cash rates are much higher, and they're probably going to stay high. Even if the Fed eases, cash rates are going to be much higher than they were before. So these are some of the structural reasons. The cyclical reasons are things like yield curves. Yield curves are getting steeper and steeper. Look at Japan. It probably has one of the steepest curves out there. And then the lending cycle. We've gone through the worst, and we're seeing a reacceleration of the lending cycle, particularly important in places like Europe. So like financials in the US, like financials in Europe, and you probably might have guessed my surname is a Greek surname.
Yes.
I really do like Greek banks as a cheaper play for European sort of financials, and even places like Japanese banks, where I think the Bank of Japan is behind the curve.
And you're focusing a little bit more on the mid caps as well, which offer value. You say, why is this the sweet spot?
The mid caps is the theme there is focus on domestic revenue generation in a world of global disruption. That's sort of the punchline, if you may, and it's important to focus at least on this, and it's important to focus on mid caps where something else big is also happening. And what do I mean by that? Again, going back to Germany, and we're seeing fiscal stimulus in Germany that we have never seen before in 30 years. And if we look at Germany, Germany has been in somewhat of an industrial recession the past few years. The large caps haven't been that much affected because the large caps have overseas earnings. A lot of that is driven by the US. The US has been a very resilient consumer. But if you look at the more, the mid caps are a lot more domestically focused. They've been very much affected by what's going on the energy side, manufacturing PMIs, industrial production. All these numbers have been relatively weak. But they're having a comeback. We've been through the worst. They're having a comeback. And as a result, German mid caps, we think, is a very interesting sort of place to focus on. Another place where something very big is happening is Japan and Japan mid caps. Again, in Japan, we're seeing for the first time in 30 plus years, we're seeing reflation. We're seeing good inflation. We're seeing wage inflation. We've had bouts of inflation in the past, but that's been all, commodities sort of imports, all imported inflation. This time around, it's more domestically focused inflation.
George, we're going to leave it there. George Efstathopoulos, their portfolio manager at Fidelity International. We are watching Pop Mart, and that stock is popping here this morning ahead of that open. There you go. After those third quarter sales growth, we're up 8%. This is Bloomberg.
All right, one market story in town. Pop Mart. No, Pop Mart's later. Gold stocks down substantially here in Hong Kong. The open is next. This is the China Show. Welcome back. Just under a minute to the opening bell here. And yeah, so we're looking at a downdraft across the entire equity complex within and in between sectors as well. When you look at equities, it's really precious metals and everything that's almost tied to gold, whether that's an ETF that tracks the miners, the price itself. That's really one pocket of the market we're following very closely, following already quite very, very steep losses in markets like Sydney, Tokyo, and also Korea as well. Yeah,
is this a sign of things to come when it comes to risk assets, right? It seems like the guests that we've talked to so far say it seems to be very just focused on precious metals here right now, given just how it was so technically overbought in the first place that they were, bound to for some sort of correction. So maybe this is just a healthy pullback. Fidelity just telling us this is an opportunity to actually buy, just given some of the structural sort of uptrend that we're seeing when it comes to gold prices there, that maybe long term it's still worth having there. And particularly when it comes to onshore markets, though, you are starting to see a bit of a downdraft when it comes to equities. So relatively speaking, I think things are looking okay for stocks compared to what you saw saw in gold. But really, you are continuing to see maybe a bit of fatigue across equity markets here after we did hit some records across this region. But yes, we're down about 0.5% for the CSI 300. We're watching very closely some of these chip names as well. I mean, Trump also casting some doubt, I guess you could say, on this, whether this meeting with Xi is going to happen at all. But you're looking like Capricorn, that's down 1.6%. Let's see how the rest of the tech space is doing in Hong Kong, because really we've been focusing on a lot about Alibaba yesterday. There were some reports about AI and the like that really kind of sent the stock going. It looks like we're down about 2% here right now for the tech space. So HS Tech is down some 1%. So maybe risk sentiment is being sapped a little bit from what we're seeing when it comes to gold prices, for example. Let's take a look at how these miners are doing, right? Because for one thing, we did see a spillover effect here in Asia. You're seeing that in pretty massive moves when it comes to some gold miners in China. So Shandong Gold is down some 6%, Jiaojing Mining also down 6%. Labubu Gold, this is interesting, could be a double whammy for the stock as well, because they also have announced that they're going to be raising close to 3 billion Hong Kong dollars from a share placement. So there you go. You're seeing 5% losses there for Labubu Gold. But then again, Dave, we're just talking about the lines that we saw in the IFC lately, given that new store opening, how, that gold demand is really what the Morgan Stanley had talked about just yesterday after they also looked at the upgrade for that stock as well. So certainly there might be still the demand picture still looks pretty good for Labubu Gold as well. But China gold ETFs, we're watching that very closely because, as Suki Cooper from Standard just told us, right, that was probably one of the big triggers of why we saw that sell down, the ETF flows there as well.
Yeah, a lot of the big ones are listed in mainland China on your screens as well. Now, going the opposite way, so we're looking at most of that certainly to the downside right now. The offset is coming from the likes of Pop Mart, should be coming up on your screens very, very shortly. We are looking at, that should be the biggest pop right now. There we go. So we're up about 5%. We were up slightly more in the pre-market. So that's after really the company reported this 250% revenue growth. That's for 3Q. Driven by this renewed frenzy surrounding its Labubu lineup. Let's bring in Charlotte Yang, our Asia equities reporter, here with us to tell us about the results. Let's start with the numbers here.
Yeah, so it's an absolutely stunning quarter. You're looking at the overall sales grew as much as 250%. And I think this is the clearest rebuttal yet to markets' earlier concerns over, the potential fading popularity of these collectible toys. And while the company does not provide a detailed breakdown of the results, which means that we don't know, for example, which IPs that contributed the most, as well as how the profitability does. But we do know is that this growth is across the board in different geography. So, for example, for China, which came from a very high base, the sales still grew 190% year over year. And for overseas, you're having some eye-popping growth with Americas that rose as much as over 1,200%. Wow. And so I think for investors, like yesterday, we had that 8% sell-off because we were worried about these results. So what this helps is that right now we have earnings visibility into the rest of the year because December quarter is a peak season. They're going to launch new themed IP products. So, and also the stock is trading at 20 times PE. So I think a lot of investors are going to think, what am I going to do with the stock? Even though, it has up 180% this year and it's still the best performing on MSCI China.
Yes, the numbers are eye-popping for sure. But as you mentioned, right, I mean, we're not sure if the breakdown of the IPs go, but I think it's really just Labubu that's really kind of leading to a lot of the growth that you're seeing. There's not that many other dolls out there that can replicate the same sort of numbers that we're seeing when it comes to Labubu, right? So do you think these numbers are sufficient to really revive more momentum back into the stock now?
I think, like you mentioned, so far, I think Labubu is still the most popular IP.
Yeah.
But we're also seeing some other IP products, such as Twinkle Twinkle, making more, social media traffic and all that. But I think for investors, yes, the numbers are positive, but I think what they're going to continue track is what are those high frequency data looking like. Because for the secondary market pricing, we are indeed seeing those premium, for example, for Labubu, getting smaller. And the company is explaining that was because, we're doing more manufacturing capacity, we have more supply. So what really is going to help investors gauge how much consumer sentiment interest still is more, I think, based on those high frequency data.
Yeah. I think Shuli's column today was quite interesting, right? The fact that they limit supply, they still keep it very limited, is something that she thinks might deter people actually from really
Chanel-esque.
Yeah.
Yeah.
I don't know. The fake demand, right? But certainly, I mean, that's one thing to watch very closely as well. Charlotte, thank you for bringing us there. What's going on with Pop Mart? And certainly, yeah, we
that's
are
Hermes.
seeing a Pop.
Okay.
Hermes as well.
Yeah.
Yeah.
That's a strategy, right?
Yeah. But then, she mentioned that, there's just so many dupes out there, right? Lafufu, Labubus, and the like.
Who knows what's real?
Yes.
In this world. That's everything. Anyway.
All right, another story that we're tracking for you out of China now. China's commerce minister says the Netherlands' move to take control of Chinese-owned chipmaker Nexperia has seriously affected the stability of the global supply chain. Wang spoke by phone with the Dutch economy minister a week after the company's seizure under an emergency Cold War-era law. Nexperia is a subsidiary of China's Wingtech Technology and a key supplier of automotive and consumer electronics chips. Chinese officials have told representatives from over 170 foreign companies and business chambers that Beijing's export curbs are a responsible act intended to protect world peace and stability. They're trying to reassure businesses that new controls are not meant to restrict normal trade. China this month outlined tighter controls on shipments of rare earths and other critical minerals.
Now, New York-based buyout giant KKR says global investors with heavy U.S. exposure are steadily shifting more capital into the Asia-Pacific. That's as the dollar loses steam and also the region's fundamentals continue to shine. Speaking exclusively to Bloomberg, Co-CEO Joseph Bae also discussed the firm's investment strategy in China.
Given the current geopolitical climate, certainly the aperture of what's investable for us today is a little bit more narrow than what it was 5 years ago or 10 years ago. Our approach, though, is we have definitely not pulled back from the China market in terms of our commitment there. We just need to be much more tailored in terms of the sectors and the themes that we think are investable. Our focus really for the last 20 years in China has been focused on domestic consumption and value-added services, which we think is a sweet spot of the Chinese economy, actually. Just recently, we announced one of the largest control buyouts in China in the largest domestic branded soft drinks business, over a $2 billion transaction. So if it's in that sweet spot of domestic consumption, local champions, we're very, very excited to invest in China today.
Are you seeing signs of M&A revival? And what do you think it will take to see a real reversal in sentiment when it comes to the Chinese market?
I think the biggest catalyst, positive catalyst for Chinese private equity, the industry, would be a clearer path to liquidity, to monetization. The stock markets need to open up so investors can exit their positions more easily. And the M&A market needs to continue to expand. It's going to be more probably sponsor to sponsor in the next 3 to 5 years. The strategic bid from international companies is probably not going to come back as quickly in China. But as the Chinese stock market improves, that path to liquidity, I think, is going to be critical for investors.
Joe, let's take a look at some of the macro trends happening today. We've been talking a lot about de-dollarization, how investors are pulling back from the USD. Do you see that? There is a debate. Where do you stand on the issue?
Yeah, I don't think it's a question of global investors exiting the U.S. market by any means. I think it's more a question of diversifying their portfolios with that incremental dollar. Where do you want to invest it? I do think it's fair to say that most global investors have a lot of exposure to the U.S. right now. And as the U.S. dollar weakens and other markets like Asia continue to have these fundamental tailwinds in terms of growth, I think you're going to see people diversify their portfolios more and more to Asia over time. And that makes sense in a multipolar world, right? As regional economies are becoming more important, as Asia is getting more dependent on intra-Asia trade and growth, I think you're going to see more and more capital flow to Asia. It doesn't mean they're pulling out of the U.S., though.
But do you see that getting momentum then, Joe?
I think it really depends on who you are and what your portfolio looks like today. You know, there are clearly some investors that probably have really very large exposures to the U.S., maybe a lot of tech exposure to the U.S., and are looking to diversify. There are lots of investors in the U.S. that have very small allocations to Asia today. And I think that's going to start shifting as well with the incremental dollar of investment. They want diversification. They want access to the growth that people are seeing in Asia. And I think you're going to see more and more capital flow to this part of the world.
Yeah, there we go. That was the co-CEO of KKR, Joseph Bae, with our colleague, of course, Linda Amin, speaking there exclusively on many of those topics. If you are one of her subscribers, you can catch that interview again, rewatch it on TV Go. That's our interactive TV function on the Bloomberg terminal. Become part of the conversation by sending us instant messages on the shows. Please keep them on topic, of course. Check it out, TV Go. This is The China Show.
We got plenty of earnings to tell you about here this morning. Netflix says a tax dispute with Brazil cut into third quarter earnings and really marring results that otherwise fell in line with Wall Street estimates. The streaming giant says it would have beaten forecasts if not for a payment to Brazil's government of more than $600 million. But it doesn't expect that dispute to have a material impact on future results. L'Oreal ADRs fell after disappointing sales growth in the last quarter as weakness in the U.S. outweighed signs of improvement in China. Now, a pickup in demand for high-end beauty products in mainland China helped lift sales by 4.2%, but analysts had expected a gain of almost 5%. And Adidas ADRs closed higher in the U.S. after the firm raised its full-year operating profit forecast. The brand is seeing strong demand for its retro sneakers amid its efforts to mitigate the impact of U.S. tariffs. Its CEO told Yi Tai that the brand is optimistic about the Chinese sports market. Bjorn Golden told the paper he expects the sector to grow at a faster pace than the country's GDP in the coming years. Texas Instruments shares fell in late trading after it issued a tepid forecast for the current period, adding to concerns that the chip industry's recovery is slowing. The biggest maker of analog chips expects revenue of around $4.2 to $4.6 billion in the fourth quarter. The outlook suggests that customers are slowing orders as they navigate mounting trade tensions and a shaky economy.
Yeah, let's stay on the chips conversation here. ARM's CFO says that a company is the CPU of choice in major AI projects from NVIDIA to Oracle. Jason Child also told us that today's AI challenge is actually supply, not demand. And they do expect both failures and winners to emerge in the AI space.
If you back up Stargate, I think they said it was going to be something like $500 billion of total spend over 4 years. As of today, we are the CPU of choice. So if you think of, say, Grace Blackwell, or even in the future, Vera Rubin, Grace and Vera, those are both built on ARM from NVIDIA. And then, of course, to the extent that Oracle's also going to be contributing, that's certainly another partner that we could be helping. And then there's OpenAI, and certainly there's, I guess, rumors of custom efforts by them. And for the most part, most of the custom efforts, there's been a lot of discussion about using ARM-based CPUs to pair with those custom GPUs. So a lot of opportunity, and it could be significant.
The numbers, I mean, you mentioned 500 billion.
Yeah.
The numbers are kind of range from 100 billion to 500 billion.
Yeah.
Is there a risk that the revenues realized won't match some of those larger aims and larger aspirations?
Possibly. We're not super close to the total spend in Stargate, but if you look at what the needs and uses are right now of AI, compute in particular, supply is far behind demand. And so at this point, I think the challenge is really just about, can you get the power, can you get the chips, and can you get the systems deployed? And so, with that kind of a demand cycle, I expect there's a decent chance that you'll see us at the high end of that.
So on that point about supply not meeting demand right now, we've seen these incredible numbers, incredible deals across the infrastructure space from the hyperscalers and OpenAI and many others. On a promised future, but not fully realized yet, does it concern you? I mean, are we seeing an AI bubble?
Okay, so when I think about bubbles, I think about, I was actually at Amazon back in 99, 2000 when things were getting frothy, I think they said. What was interesting there is there was a bunch of build out, but a lot of that build out wasn't really being deployed or it wasn't being fully utilized. If you think about all the servers, all the websites, the shipping capacity, etc. What's different in this cycle is the problem we have right now is supply, not demand. That was really more of a demand issue. This is really, right now, our challenge is supply. So I think the question is going to be, is there going to be a situation where you have a bunch of companies that probably have raised capital and maybe are pre-revenue? Is there a bunch of those companies that maybe won't make it out? So are they going to be the Pets.com or Home Grocer or Webvan or whatever? Sure, that certainly could happen. But are there also going to be the equivalents of Amazon, Google, eBay, Yahoo, these other companies that actually were, quite large and became, pretty huge companies? I expect that to happen as well. So how we define bubble and who's the winners and losers, I think that's all to be seen.
There we go. Yeah, that was Tom McKenzie there speaking with the CFO of ARM, Jason Child. Right, we have plenty more on the way. We'll get you guys an update on this precious metals route. We're seeing equities are also falling largely along the same lines and reasons. 1.4% on tech. Plenty more ahead.
All right, we're focusing on some of these chip stocks here in the region. So we are seeing a bit of profit taking potentially. It might be due to what we're seeing in SoftBank, some wobbles there on that stock in Tokyo. Also, when it comes to Texas Instruments, we just talked about how that disappointing guidance there. So that certainly is leading to some of these chip names to fall out of bed here this morning. So that's one to watch here as well. The AI trade and the like. There you go. Hua Hong Semi, for example, is down close to 4% here right now. We're also watching Innovent. So this is, of course, the biotech company. Shares rising here. After the company said it's going to receive a $1.2 billion upfront payment. So there's this collaboration with Takeda Pharmaceutical to develop cancer therapies here. So we're up 4% for the stock right now.
Okay, yeah, let's hope they really succeed as far as that goes. An update to across the other parts of the market. Precious metals coming up on your screens. We are looking at some of those coming up as well. Some of the big names, of course, here. Are we looking at that too? Yeah, so Shandong Gold, Zijin Mining, some of the big winners are obviously feeling the reversal of gold prices overnight. Some of the gold ETFs, we'll talk more about this. A lot of the big ones are in fact listed in mainland China coming up as well. And of course, vaccine stocks and the news coming through early this week out of CCTV that the flu season, influenza season has come slightly earlier in the southern part of the country. And yeah, some of these are actually continuing to see some upside going into that.
Yeah, I mean, it's getting cold again here in Hong Kong. I mean, I say cold, relatively speaking, it's cooled down a bit, but I'll take it.
Yeah.
Right. But yes, that does lead to maybe flu season is underway. Let's talk a little more about EVs, because certainly we continue to watch the price competition and the price wars there. Obviously, we've been talking a little bit more about just how competitive things have been in the auto sector there in China. Domestic firms, though, are continuing to bet on innovative vehicles to capture market share. Let's bring our Asia Global Business Managing Editor, Rachel Chang. She joins us now with the details. So despite what we're seeing, everyone's talking about consolidation, you're starting to see some very niche sort of car names and brands emerge here. What is this telling us about the industry overall, Rachel?
Yeah, it is really interesting because, we do know that this industry is really oversaturated. There's over 130 EV car brands right now in China, the world's biggest car market. But still, we see newcomers coming in all the time, thinking that they're going to be able to offer consumers something that's not already there. For example, we've got Dream and Rox, two new EV companies that actually started from being robot vacuum makers. And what's interesting, of course, is that Dyson, the very famous vacuum maker, tried to make a car for a long time but failed. But in China, it's all possible. So, they're launching new cars. We've got lots of new players as well that are aiming for maybe the ultra luxury niche, for example, offering cars that have inbuilt kitchens that can, just open up and you can live in that car. Or we're seeing also car brands coming in and trying to really dominate or try to challenge BYD in that mass market space for really, really affordable cars that would go for much less than they would go for in Western markets. So it's still a really competitive space. And I think the question is, who's really going to survive? We have analysts saying only 15 brands out of that 130 will survive in the long term. But clearly, a lot of companies still feel like they've got a shot.
Yeah, and they are, Rachel. They're taking it. And I wonder, is there any early indication right now that some of these niche categories don't eventually fall into the trend we've seen across most sectors or most price points? It's really cutthroat competition.
No, I mean, I think that competition is happening everywhere. What we see in China is that there's just still so much excitement around EVs, and there's just so much investment, so much money looking for companies to plow into, right? A lot of these companies are coming in because they've had huge, investments from other parties, sometimes state governments, and they just all want to take that shot, I guess because EVs is, for China anyway, just one of their most successful overseas technological exports, and everybody wants a bite of that apple, but ultimately, the vast majority of these brands will, in 10 years' time, no longer exist, and there'll be a lot of money that's gone into that doesn't go anywhere.
All right, Rachel, thank you so much, Rachel Chang there, of course, on this latest.
Yeah, who doesn't want a little live-in kitchen in their car?
In your car, right?
Or even a little RV with a mattress at the back.
It's such a weird concept that they've taken the fossil fuels out of the actual engine and literally put them in the car in the form of that mini kitchen.
But it's just the way of how they're changing the whole industry, right? It's not just about, these vehicles are a means of transport anymore. It's a whole lifestyle sort of thing. So maybe that's why there is that value up there still right now in the face of all this competition. But you got to stand out somehow.
You do. You need a kitchen, certainly, when you do a massive road trip, right? You in the middle of nowhere, right?
Yeah.
Just, okay. Anyway, you need your protein when you need it. Okay, a check of these markets very quickly. We have a trading debut today. Fibocom is coming up shortly on your screens, 5% to the downside. Fibcom Wireless. Now, on this note, we'll talk more in the next hour of the China show. Certainly, this other big listing onshore, which we'll get to a bit later on. In the Asia market, we're talking chips at quite a substantial in terms of scale. More on that. Plus, of course, we'll continue the conversation around gold and the route we're seeing there. This is the China show.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session. Yeah, it's cooling down in temperatures here when it comes to the weather, but we're seeing a little bit of cooling there when it comes to these equity markets as well. Hang Seng is down 0.6%. The gold space certainly has been kind of what we've been seeing as might be the drag in terms of what we're seeing in terms of miners and what we're seeing the gold price there. That 5 standard deviation move in the gold price overnight certainly is maybe indicative of what could happen to risk assets, right? That's a key question, right? Does this happen just the precious metal space in a vacuum, or does it spill over to other risk assets here right now, Dave? Given that we are seeing these correlations with the dollar, with stocks, with everything else, seems to be everything going up. Does everything also come down too, Dave?
Yeah, we are seeing it somewhat. It isn't as strong as the gold price move itself, and I think when you look at, and it's, certainly I'll use the cooling analogy there because across asset classes, precious metals really were over, the most overheated asset class when you look at momentum, right? This is a 14-day RSI. Yes, it's a daily chart. 14-day RSI of spot gold, right? So I'm going to use the endurance sport analogy here. We've been, we've been trading above threshold pace for about 2 months now. So gold, when you look at this specific metric, was actually above the 14-day RSI of 70 for 2 entire months. And context is key here, right? Because when you look at the price drop, what we're seeing the last 24 hours or so, in fact, flip the page, please, we are seeing an extension of that. We're simply back to levels of last week. It's not as if we've taken out an entire year's gains, because to take a lot of that really to the downside. So we're looking at some of the spot prices, as you can see, extending that. We're coming off lows of the day is also worth pointing out. We are getting a catch-down trade, though, when you look at some of the ETFs traded here in the Asia-Pacific, everything from some of the names in Australia, some of the big name-specific stock names tied to the gold price, like Labubu Gold, Shandong Gold Mining, of course. This one, of course, also has a cash call today, which might be exacerbating the move even further. Some of the big gold ETFs, of course, trading. This is the biggest one in terms of assets across the Asia-Pacific. Japan Physical Gold ETF is also in the top 5. Now, the question I think that Yvonne was posing there is, is this breaking of momentum, which we saw in the equity complex overnight as far as the biggest factor moves, momentum, as you can see, clearly going against the grain. Is this a warning sign for other asset classes, or is this simply still a precious metal space because of some of the conditions we just outlined for you there? I mentioned we are seeing that somewhat today. Some of the common denominators, of course, that apart from obviously being momentum, some of these big tech plays have done very well. So there is some temptation to take a lot of money off the table. So we talked about gold. And the big decliners as far as sector groups go in the Asia-Pacific complex, materials, that's obviously tied to gold. But IT and tech are also seeing some heavy pressure today, Yvonne.
Yeah, the MLI block is talking a lot about this, and I want to kind of talk a little bit more about what Michael Ball is writing about, macro strategist based in New York. And when everything is going up, Dave, when you have stocks, bonds, gold, dollar moving all in tandem, what does that tell you about the playbook now? It seems like the traditional ways of looking at investing have really changed into some new market regime when it seems like, he says, AI trade, it seems like volatility, it seems like liquidity matter more to this market now than actual macro fundamentals. That certainly is the case that we're seeing here today. We spoke to Standard Chartered and Fidelity in just the last hour or so, just really about these big market moves that we're seeing in gold. And this is what we heard this morning.
We think the crucial factor here is really around ETF demand, ETP holdings. On a global basis, holdings have reached 3,900. At its peak, holdings were 3,920. So we're very, very close to that all-time high in tonnage levels. And that peak was set in October 2020.
There's been other factors as well that have been driving this exponential increase in gold the past few weeks. It's been the shutdown, and it's also been the geopolitics between US and China. Some of these now seem to be getting a little bit better. The news flow that we're seeing has been a little bit better, and as a result, it makes sense for gold to consolidate somewhat. But I personally would think of this as an opportunity to buy once we see some stabilization there.
Joining us now is Bart Melek, Global Head of Commodity Strategy at TD Securities. He joins us from Toronto this evening. Bart, thanks for staying late with us. Bart, given what we saw in the moves, were quite eye-popping. I'm just wondering, what do you think was really the trigger overnight?
Well, I think there's a lot to be said about profit-taking and momentum just basically slowing down here. You've showed a chart of the RSI measures. They were well over 80, well above the 70 mark for quite a few months. I think this market was getting a little stretch here. For example, in terms of the 200-day average, at one point we were trading 35% above the 200-day average. Usually that doesn't keep up indefinitely. There's usually a decent 10 to 15% correction when that happens. And at the same time, when we follow the CTA market quite closely, and we've seen a quite large reduction from as much as 70% of maximum exposure to now 20% on CTAs. That means the momentum for the trend followers has dried up. We've seen more volatility. These algos are also very much VAR targeting. As volatility moved for a while to the upside, I think a lot of them had to sell because they were adjusting VAR. And let's not dismiss just plain old profit taking by proprietary traders or discretionary traders, if you like, who for much of the year were simply not in this trade and missed out. They got in, they made some money, and I'm not so sure that the story of very aggressive Fed cuts is going to continue, into next month, for example.
Bart, David here, just to continue that thought on momentum, if you could. So, the very short term, when the next 5% move on gold, do you think that's going to be up or down?
I think we have strong support around 4,000 or so, 40.50, 4,100. We can break through temporarily, but I think we're going to have to test the 4,000, see if we consolidate there, if the big macro fundamentals are there, if central banks continue to buy. So far, they are well on track to buy well over 1,000 tons, as they have been buying since 2022. I think gold fundamentally looks very good. This whole debasement trade is still very much on. U.S. continues to run massive deficits on top of a massive debt of north of $37 trillion, and we have a very strong possibility that come May 2026 we're going to have a dove in the chair's office and an FOMC that's not going to be too shy to target maximum employment mandate as opposed to the 2% inflation target. So real rates likely will drop, particularly on the short end of the curve, into negative territory. And we have seen, pre times when Mr. Volcker was still unsure how to destroy inflation, when those real rates on the short end of the curve go steeply down, gold tends to do well because it is, after all, a very good inflation hedge because it's a real asset that requires labor and real capital to produce.
And should I expect the likes of silver, palladium, the like? I mean, are they going to just go follow what we're seeing in gold, or are there nuances in some of these precious metals too, Bart?
Oh, absolutely. Particularly silver is quite nuanced. One of my colleagues, we put a short position, just before the peak, and that one is very much driven by the fact that a lot of metal in the hundreds of millions of ounces went from the LBMA system into the CME system in the United States ahead of the tariffs, and now that material is coming back and loosening that squeeze in the LME, and now, of course, we're seeing the Indian demand because of Diwali, ease up a little bit. So all those factors, I think, were working in tandem to get that correction going. But by no means do I think the precious metals bull market is over. I think we're going to consolidate, and as we should. No market ever goes up continuously in a straight, uninterrupted path.
So Bart, in a nutshell, what would the advice be in terms of exposure? Is this a buying opportunity? And in terms of what drives your price projections forward, where are those flows going to come from?
Sure. We're looking at, for gold in the first half of next year, 4,400 average quarterly price. And that's important to distinguish peak price versus quarterly, because you can easily assume 350 volatility. So we could easily see 47 plus 100 gold within the next 6 months. And what's going to drive it? I think very dovish Federal Reserve policy relative to where U.S. inflation is, and continued massive acquisition, increase of debt. Part of the reason the U.S. economy is doing so well is because the U.S. debt is growing massively, and there is fiscal stimulus. So that's probably going to be unchanged. And we are facing problems on the labor front in the United States. There are inflationary pressures because of tariffs. They might not be 6-7%, but certainly they will keep inflation well over 3%. And that means when the Fed eases, we're going to be in negative rate territory. And if we partake into some sort of QE program, some sort of Operation Twist, where we take, 2s, 3s, 10s artificially lower and move those real yields down, I wouldn't be surprised to see this bull run continuing. But for now, I think we're consolidating the gains and testing support levels.
Bart, thank you so much for staying up. We appreciate it. And let's speak again, Sir Bart Melek, their Global Head of Commodity Strategy at TD Securities. Coming up here on shows, we'll pivot back to geopolitics. And we'll be speaking with Eurasia Group's Dan Wang on this potential Trump-Xi meeting next week and her expectations for the current ongoing exercise, the fourth plenum. Plenty more ahead. This is the China Show.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years.
President Trump there talking about a potential trade deal with China after casting doubt on whether he'll meet later this month with President Xi Jinping. Let's bring in Dan Wang now, China director at Eurasia Group, who joins us from Singapore. Dan, I understand you just came back from a trip to Beijing. What were conversations like there? Is there any indication that this meeting is going to happen next week?
So it sounds like the meeting is highly likely to happen. The signal I pick up in China meeting with the regulators are quite positive, and China has been making efforts to make sure top-level meetings will happen ahead of the Trump-Xi meeting. And it's confirmed that Treasury Secretary Bessent will meet his Chinese counterpart in ASEAN summit. And the recent rounds of tit-for-tat escalation doesn't sound like anything beyond a negotiation tactic. So I believe that China at this point has invested heavily in Trump, so they would make sure that the meeting will happen unless something drastic have derailed it.
And what is your understanding of what the points of agreement already are? In other words, what's largely been agreed on, and what else is on the table?
At this point, it's still, because it's not officially confirmed, so there are a lot of speculations. But based on piecemeal information, it just seems like everything is on the table. We have been hearing about talks over fentanyl, over soybean, over China's commitment to invest in the U.S., and also over the expedite approval for the rare earth export. So overall, it just sounds like the sentiment is quite tense, but towards a more positive result, possibly. And we still believe a transactional deal is very likely to happen early next year. It doesn't mean the end of the trade war, but at least it's a milestone.
Yeah, tell us a bit more about the rare earth side of things, because I think it led to a lot of, I guess, confusion, not just in the U.S., but even Europe and the rest of the world, about what China is doing in terms of using this leverage in this whole trade battle and war. Do you think that there really is going to be any sort of breakthrough when it comes to the export curbs around these critical minerals now?
I don't think breakthrough is likely, because China has figured out how effective this rare earth export control is and could be in the future trade talks. So the mechanism is in place, and China is perfecting it throughout the last year. And what is quite obvious now is that the U.S. will use more pressure on when it comes to the tech export. So for China, there is enough intention to, of course, expedite the approval of the rare earth to the U.S., but it's going to be a very difficult negotiation overall.
So you mentioned that some things will continue well beyond this meeting. So just a last point on rare earths, if it's okay. Should businesses get used to this new reality? Is what I'm trying to get to.
I think the world is not ready to have China on the other side of the aisle actually having this monopolistic power over a critical resource. And for China to be so effective, it actually surprised both Europeans and Americans. Most of the companies and countries, they are more worried actually about growing dependence on China rather than disruption on the actual production. So their fight back on this battle would also be quite intensified. And judging by what's going on in Europe, especially with the Dutch company, then we can see actually more likely similar things can happen in the future.
Okay, well, whether countries are ready for China to be on the other side of the aisle or not, do they need to get used to it? I think, to your point, right, the pushback might be something we are underestimating. Do you think then we will meet somewhere in the middle as far as this is concerned, some of the policies and restrictions around critical minerals? Is there a diluted version, effectively, of what's on the table right now, you see?
I don't think there is a point in the middle. We are effectively in a Cold War equivalent scenario without trade decoupling. So neither side can afford to appear weak when it comes to this kind of negotiation. So for China, rare earth is the most effective tool. And if anything, they could have extended this tool to other areas of the economy. For example, semiconductor. China rely on the U.S. for the cutting edge, a top level of semiconductor, but China dominate on 40 nanometers semiconductor that's used in cars. So if it's proved not to be effective, just use rare earth, China could leverage on its other supply chains in order to gain more negotiation power.
Well, I was going to ask you about Taiwan, because that seems to be an emerging issue that might be discussed next week if this meeting goes through. Dan, it's interesting that Beijing, from what we're hearing, is wants the U.S. to change their stance when it comes to Taiwan. How do you think the U.S. might respond to this? And if it does change its stance, is it just a matter of semantics, or do you think it would actually have global implications?
If somehow Taiwan issue becomes part of the negotiation, it will change the entire landscape of the trade talk and also the trade supply chain, because it's not just about semiconductor, it's also about how China would view the rest of the world. And we do not believe that Taiwan risk is as high as what a lot of people have thought, but the possibility of a blockade or other kind of countermeasure from China is possible if the U.S. appear more assertive on the Taiwan issue. Trump is China's best hope, actually, to get to be on the negotiation table and be friendly to China, because our understanding is basically it's bipartisan to contain China, especially the Taiwan issue. Whoever comes after Trump will be much harsher on China regarding Taiwan.
Interesting viewpoint. If I could ask you to remove the geopolitical hat for a moment, put back your economist hat, if you could, for us. What's the content? Where do you think the economy? How do you think the economy is doing, given all the numbers that we've seen recently, and how does that inform you of what potentially what we could hear on consumption out of the fourth plenum?
Well, we have all seen the figures for the first 3 quarters, the GDP, the manufacturing investment, the export. It's surprised on the upside. I wouldn't go so far as to say these are fake data, but as indicators, they have lost all meaning for guiding business decisions. So it's more important to actually study cases in different areas of the economy. Besides the emerging industries, the strategic industries, there are also other positive opportunities in China. For example, we all know the rise of high-end retailers in smaller cities like Pangdonglai is a perfect example, and the thriving stand-up comedy show industries in China, and the famous soccer tour in Jiangsu. So it's cases like that that actually is more indicating, more telling about what is going on as a quiet transformation. But when it comes to housing or consumption stimulus or bailout, there's very little indication. I do not believe the government could or have the willingness to, in fact, put on more stimulus in those fronts.
Dan Wang, thank you so much for all the insights there. China Director at Eurasia Group, joining us out of Singapore this morning. If you're one of us subscribers and you want to rewatch that interview and the many sort of conversation insights that are coming through in the last few minutes or so, TV Go, run that on your Bloomberg terminal. You can scroll back, and we touched on many of the key issues that investors are trying to understand better as we head into the crucial meeting next week. Check it out, TV Go. This is The China Show.
Some earnings news to tell you about this morning. Netflix says a tax dispute with Brazil cut into its third quarter earnings and marred results that otherwise fell in line with Wall Street estimates. The streaming giant says it would have beaten forecasts if not for that payment to Brazil's government of more than $600 million. But it doesn't expect that dispute to have a material impact on future results. L'Oreal ADRs fell after disappointing sales growth in the last quarter as weakness in the U.S. outweighs signs of improvement in China. A pickup in demand for high-end beauty products in mainland China helped lift sales by 4.2%, but analysts had expected a gain of almost 5%. Adidas ADRs closed higher in the U.S. after the firm raised its full-year operating profit forecast. The brand is seeing strong demand for its retro sneakers amid its efforts to mitigate the impact of U.S. tariffs. Its CEO told Yi Tsai that the brand is optimistic about the Chinese sports market. Bjorn Golden told the paper he expects the sector to grow at a faster pace than the country's GDP in the coming years. And Texas Instruments shares fell in late trading after it issued a tepid forecast for the current period, adding to concerns that the chip industry's recovery is slowing. The biggest maker of analog chips expects revenue of around $4.2 to $4.6 billion in the fourth quarter. The outlook suggests that customers are slowing orders as they navigate mounting trade tensions and a shaky economy.
Okay, let's start things off with chips as we talk about Texas Instruments there. So that's really one group of stocks that's seen substantial pressure right now. And of course, within that, you're looking at the likes of SoftBank, which should be coming up, if not already, on your screens. We have SoftBank there? No, we don't. Okay. Anyway, coming up, there we go. Thank you so much. Down about 5.3%. So that's really a profit-taking story. Apart from other things at work, we'll talk more about the Japan story in a moment. CXMT, Reuters reporting this massive listing in Shanghai, $40+ billion valuation, could raise $40 billion. We'll end on golds, and we look at these other things as well. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are going to a break in just a moment. And right now we are seeing a bit of red when it comes to Nikkei 225, which is marginally lower by about 0.5%. Topics is doing a little bit better here this morning, but we are seeing some strength in the currency at 151 levels here right now. Obviously, we've been really counting down, looking a little bit more into Sanai Takaichi becoming, of course, the first female prime minister of Japan and securing a parliamentary vote after weeks of negotiations with opposition parties to form a coalition. Our Asia Trade co-anchor Sherry An takes a closer look at Japan's new leader and the challenges ahead.
Elected as head of the ruling Liberal Democratic Party in early October, Sanae Takaichi was a protege of the late Prime Minister Shinzo Abe. Seen as politically right-wing, a supporter of fiscal stimulus and a foreign policy hawk, she has touted conservative values on issues such as women's rights. Offstage, she's known to play the drums and for being a fan of heavy metal music and Margaret Thatcher. Her LDP leadership got off to a rocky start after coalition partner Komeito quit the 26-year alliance, forcing Takaichi to strike a deal with the Japan Innovation Party, the third largest bloc in the lower house. Even with this new coalition, challenges loom. Takaichi must reunite the party and re-engage with voters flocking to smaller populist groups. Japan is also grappling with rising costs of living and challenges with its migrant population.
There is a concern over the Japanese people with too much concentration of the foreign people in certain areas.
Markets are embracing the so-called Takaichi trade, pricing in larger fiscal deficits and heavier JGB issuance. Takaichi is expected to meet with President Trump in the coming days and attend both the APEC and the ASEAN summits in Asia. As she steps onto the world stage while also facing daunting domestic challenges, the focus will be on how she handles the pressure. Sherry An, Bloomberg, Tokyo.
And let's get more on Japan's new prime minister and how the government there is currently taking shape as some of the top positions have started to get filled. Let's bring in our economy and government editor, Paul Jackson, joining us out of Tokyo this morning. Paul, good morning. So, talk to us about what we know about the new cabinet. Any names stand out to you?
Well, I think we have a cabinet here that's aimed at helping unify the party by bringing in some of the other contenders for the LDP leadership into the fold, gives them roles in the new administration. I think we're also seeing cabinet members, namely Satsuki Katayama, the new finance minister, Minoru Kiuchi, who's the growth strategy minister. These are people who are in favor of active fiscal policy. So this is very much in line with what we were expecting from Takaichi. It's going to be a government that's going to be not shy about spending in order to achieve growth. They will be hammering out the line that they will be responsible with the active fiscal policy, and they'll be trying to focus attention on Japan's net debt ratio to GDP as their kind of metric of how fiscally responsible they're going to be. It's an interesting pairing. those two, because they have some history back in the past competing for the same constituency, with both of them with one win each. So I could say there's a bit of bad blood between them, but they seem to have buried the hatchet. In terms of other cabinet posts, we've seen Toshimitsu Motegi become foreign minister and Ryosei Akazawa as trade minister. So we've got a bit of continuity from the Ishiba administration there with Akazawa. He was the point man on trade negotiations. So keeping him in the fold kind of makes sense. And now he's become trade minister after kind of effectively being the trade minister previously. Motegi is a kind of veteran. He's been in all the major posts in the cabinet pretty much. And he was also involved in negotiations with Trump in the first administration. So that's pretty handy because, of course, we have Donald Trump visiting Japan soon. So we want people who know him and have dealt with him before helping in handling that visit going forward.
Yeah, the economist from Bloomberg Economics, Taro Kimura, was talking a little bit more about the room for fiscal policy in this new government. And his headline for his latest reaction piece is about the fear of a trust moment means fiscal cap. Can you tell us a bit more about how much room there is for fiscal policy, and are these kind of fears of a Liz Truss sort of moment? How is that being? What's the reaction in Tokyo, for example, on that?
Yeah, I mean, I think this government is trying to make out they're going to be responsible. This term, responsible, kind of active fiscal policy, is something that Katayama and Takaichi came up with together. And I think that's what they're going to be trying to push forward. They're not going to do anything totally radical. Now, if you talk about the Truss moment in the UK, I mean, the kind of percentage of GDP suddenly spent on spending that Liz Truss did that totally spooked markets, that will be equivalent to, say, scrapping the sales tax entirely. Now, at the moment, the most ambitious plan that they've got would be to reduce for 2 years the sales tax on food only. So that's something around about 4.8 trillion yen's worth. This is not on the same level as Liz Truss. So at the moment, I don't think we're anywhere near a Truss moment. But of course, the devil's in the detail, and we will have an economic package coming up. Takaichi's already asked for that. And so when we start to see the real numbers coming out, then we'll know whether we're in that territory or not. But I feel it will be a little bit more scaled back than that.
Paul, thank you. Paul Jackson there, Japan economy and government editor, joining us out of Tokyo. We're talking a little bit more about KKR now in that interview that we just brought to you. Well, when it comes to the buyout giant, I mean, they are ramping up in Japan, deploying capital at 5 times the pace of a decade ago. Tokyo is now the firm's most active investment destination outside the U.S. and its largest Asian market. Speaking exclusively to Bloomberg, the co-CEO Joseph Bae discussed their investment strategy in Japan and their expectations for the new prime minister.
I think the key in Japan is really the continuity of the policy, really starting with Abe, right? We've had a number of prime ministers since then. But each of these successive prime ministers has continued and expanded the reform agenda here in Japan. And our hope and expectation is this new prime minister will be committed to that same reform path. If that happens, I think the future is very, very bright for Japan.
What's the plan then, Joe? What's the plan for Japan? What is the strategy? How do you grow your foothold in that important market for you?
Well, there's an evolving marketplace here. Right. So traditional private equity focused on corporate carve-outs will be our bread and butter. We're seeing more and more activity there. You're seeing more secondary transactions, more public to privates. So I think that speaks to how the private equity industry is maturing here. And beyond that, it's the emergence of new asset classes. So infrastructure investing in Japan is starting to pick up. The need for data centers and digital infrastructure is a really attractive theme. Energy in Japan is a critical issue for the Japanese economy. That's going to take a lot of capital and a lot of private capital to support that. You're also starting to see the emergence of private credit in this marketplace to partner and complement what the Japanese banks are doing. It's going to provide more risk capital and more sources of capital to Japanese companies and entrepreneurs. So there are a lot of different ways to scale our platform here in the market. And most recently, it's around insurance. We have a very large insurance platform called Global Atlantic. we are partnering with Japanese insurance companies to bring them solutions for their policyholders.
You talked about private credit, private equity. You talked about infrastructure. India comes to mind as well. This is one market that has enormous potential. How are you looking at the Indian market? They say that it is coming of age right now.
Yeah, India is an amazing country to invest in. After Japan, India is our second largest destination of investment in Asia. It's underpinned, I think, but by what everybody knows. 1.4 billion people, an incredible demographic story, an incredible consumption story. And you start layering on top of that, more recently, a manufacturing industry that's starting to blossom as well.
And what's the plan for infrastructure in India in particular? We know that this is a growing business for you. In fact, if you take a look at the numbers, it's grown from 13 billion in 2018 to 60 billion right now. And your Asia Infrastructure Fund has been looking to deploy capital, and India could be the biggest beneficiary. It sheds some light on the plan there.
Sure. I mean, India for us is a big destination for both private equity investments as well as infrastructure investments. Our Asian Private Equity Fund and our Asian Infrastructure Fund are the two largest vehicles in their asset classes in the region today, and India is a core destination. So already today in India, we've invested behind toll roads, transmission grids, renewable energy, and digital infrastructure. So I think we're just getting started, but it's going to be one of the largest destinations for infrastructure capital going forward.
KKR Co-CEO Joseph Bae there, speaking exclusively with Has there. Certainly we're watching currencies, and looks like we are seeing a bit of strength when it comes to the likes of the yen here this morning. So dollar's taking a bit of a backseat here, but Aussie yen, that's kind of the risk barometer here. We are seeing some declines on that pair. And yes, we are seeing some wobbles in the equity market here in Greater China this morning. Hang Seng down 0.5%. Shanghai Composite also down by about 6 points here this morning. We got plenty more ahead. This is Bloomberg. Taking you live pictures right now where Japan's new foreign minister Toshimitsu Motegi is holding his first press briefing since taking office just yesterday. And what we're hearing so far from the new foreign minister, he's talking about security environment is increasingly complex. Also talking a bit more about the concerning trends towards Russia and North Korea ties. So that certainly is what the latest from the new foreign minister. Motegi, as we just talked about here, was part, of course, of the negotiating team for the country during Trump's first presidency. So his experience when it comes to trade and the like is going to be in very high demand when President Trump does visit Japan next week. So I think now that this cabinet that has been formed, I think that really kind of shifts the focus for Takaichi here to really focus on global affairs versus really domestically now that the cabinet is up and running.
Yeah, I mean, well, he's talking about how the complications happening outside, the concerning trends, as he puts it, will basically take this alliance between the U.S. and Japan a step further. Now, earlier on, unrelated to what you're seeing on your screens, the chief cabinet secretary has now put out some dates for that visit of Donald Trump, that they are planning for President Trump to visit Japan on October 27 to 29. So that's in about 7 days from today. And of course, that then takes us into the rest of the meetings across APEC. But yes, it's going to be a very jam-packed schedule on the geopolitical front next week.
Yeah, so he's saying they're going to take the U.S.-Japan alliance a step further. They're going to strengthen its network with India, Australia, as well as Europe. You take a look when it comes to gold prices. Certainly that the geopolitics might be a reason as the trigger of why we saw such a massive sell-off and why we're continuing that here today. So certainly we're still watching, of course, spot prices here this morning. It looks like, as we've been talking to our guests, 4,000 might be that sort of support level for gold prices here right now as the sell-off stabilize a little bit, but we're still looking at the other precious metals as well, like silver too.
Yeah, because everything got sold off and really dumped out the window yesterday. I think in silver specifically, we are seeing somewhat of a stronger bounce coming off lows, relatively speaking, of course, where you are in gold. But as you can see, over a 2-day look, we're not even close to reversing all of the losses that we had. We are still trading, though, below that 50 handle on silver spot. It wasn't too long ago, quite literally just a few days ago, we were trading north of 52.50 on the likes of silver. Also coming off lows, just to tell you about this, an update of equity markets is the Hang Seng Tech Index gap lower, and then we've started to come across the lows of the day as far as the Hang Seng Tech Index goes. I'm just looking at my screens right now. Let me just bring up some of the breadth in terms of what we're seeing here on the Hang Seng Tech Index. We're looking at, just give me a second while this loads, 20 down, 10 up, 0 unchanged. In terms of market breadth, we're looking at the likes of Kingsoft, Hua Hong Semi, NetE, some of the big decliners to the downside, but the offsets are now coming in the form of some of the big EV plays like NIO, for example. Hires up about 1%. Meituan, which by the way got a downgrade earlier on, is trading steady. And of course, Horizon Robotics and SMIC2 to the upside here today.
Yeah, and let's talk a little bit more about just another line that just came through in your terminal here. Another scoop from our team at the ECM team. Bloomberg has learned that Innorna, a Chinese developer of mRNA drugs, plans to list in Hong Kong. For more details, let's bring in Manuel Balgori, who leads our Asia-Pacific deals coverage. Yeah, it's tough to pronounce that one, Innorna. But it seems like we see you every day here, Manuel, on the show. Tell us a bit more about what we know so far.
It's a great pleasure to be back, Yvonne and David. It's another biotech company. There has been a rush of healthcare IPOs coming to market, which is very exciting. It's not at the level that we saw, remember, like 7-8 years ago, where we saw like biotech IPO almost every week. It was crazy, right? Those days are gone. But it's really positive to see the momentum building in the sector again, and we're seeing more and more new companies looking for IPOs. Some of them will materialize before year end, others into next year. Innorna is the latest that we just reported this morning. Interesting too, because they have some backers like CDH Investment, so they've done some proper fundraising rounds in the past, so they're looking for some liquidity event in there.
Now, just to look at the onshore markets, some reporting today about this very big chip company, CXMT, Shanghai listing.
Yes, David, which is quite surprising too, because we have rarely seen any onshore IPOs. So it'll be interesting to see how this one pans out. It's been in the making for a while. So it sounds like they are getting everything ready, regulatory approvals, all the steps are required in order to be listed. Now, these things usually take a long time. Potentially others may also tag along and explore similar situations. But this one, I agree with you, this one will be very big and in a sector which is very sensitive and very hot these days. So it remains to be seen. I would characterize this as work in progress for now.
Yep. Okay, Manuel, thank you so much. For ECM bankers, the more you see Manuel, the bigger your bonus likely will be. That means things are busy.
The more busier you're going to get, basically,
Well, it depends on your fees, of course. So also, consider competition as it pertains to that. Of course, Manuel there, who leads our Asia-Pacific deals coverage. And that one we just talked about there, Reuters, of course, reporting that chipmaker CXMT, Shanghai listing, $42 billion valuation. Right, and back here to Hong Kong, one name that is debuting today, not the best one. We're down about 8% on Fibocom. Wireless is trading almost on a daily basis, a new one that we talk about here. Plenty more ahead. This is the China Show.
Thank you.
All right, gold's been a big story that takes us directly into the FX space. So you have the rand, and of course here in the Asia Pacific, it's the bahts that spike you see on your screens was the gold weakness. And since that point in time, we've seen, of course, some strength coming through. Dollar weakness is the other side of that, of course, going into today. We're also getting some of the minutes coming through out of the Bank of Thailand meeting, and just being ready to adjust policy as needed, reverse course. And that takes us then into another central bank decision that is set to come out later today out of the Southeast Asia.
Yeah, Bank Indonesia, right? And obviously the last meeting was a bit of a surprise when it came to that cut. So are they likely to see another cut? That seems to be what economists are expecting here this time around. So out of the 37, 27 are saying that we could be seeing that cut here today. Let's bring in our Bloomberg Deputy Indonesia Bureau Chief, Claire Yao, joining us out of Jakarta. So cuts expected here. What else should we look out for today?
That's right. We're expecting a cut this month. Recall that in the last 2 or 3 months, Bank Indonesia has surprised the market, preferring to cut instead of hold despite the rupiah's relative weakness. So what we should expect to see is more of Governor Periwarjio's all-out pro-growth stance that he signaled last month. And a lot of this really roots on the government's concern about where Southeast Asia's largest economy is going. The economy already has weak consumption. It's been hit with job layoffs. And then it's also contending with the impacts of this global trade war. And what we're seeing is policymakers have this all-hands-on-deck approach. Other than Bank Indonesia signaling more easing, we're also seeing the fiscal side promise even more stimulus. We've already seen roughly about $6 billion in stimulus so far this year, the latest coming last week, with more cash aid for about 35 million families and job internships for fresh graduates. What we're hoping to see today is that the governor will also support this growth push with more easing and potentially even more incentives for lending to sensitive sectors that hire more workers.
And Claire, what are the implications here on the currency?
Yeah, so far we've seen the currency regain some strength a little bit this month, but if you're comparing it to last month's rate decision when Governor Warjio signaled a more dovish approach, it's actually weakened about 1.2% already. And of course, currency stability is Bank Indonesia's primary mandate. It will be something that they're keeping their eyes on. Things that will give them space to keep on being dovish. First, we have pretty low inflation in Indonesia. It's well within Bank Indonesia's 1.5 to 3.5% target. But more importantly, expectations of more Federal Reserve rate cuts. If we see more rate cuts at the meeting later this month, that keeps Indonesian assets relatively attractive to investors, and maybe as a sign of their confidence of investor interest in Indonesia, they're even said to be considering a UN bond offering of about 5-year and 10-year tenors sometime. So it seems to me, while the Bank Indonesia seems to be tolerating a weaker currency so far, they're also confident that these foreign flows will come back to Indonesia.
All right, Claire. Thank you. Claire Yao there, our Deputy Indonesian Bureau Chief. Of course, we're checking markets, and it's still really about that gold story here. We talked about the correlations when it comes to the likes of Thai baht, the rand here. That certainly is going to be the key focus. And we're focusing really on these miners as well, which is following really that gold price lower. Albeit, though, Dave mentioned, we are bouncing off some of the initial lows for gold prices here this morning. So things are stabilizing a little bit. But you're still seeing the likes of West Gold Resources, for example, down some 10%. What else are you watching, Dave?
Yeah, I mean, the temptation to really scratch this itch was, I mean, just imagine trying to control scratching a very itchy spot for 2 months, and then you're now suddenly allowed to reach that spot on your back that's been nagging you for several months.
And then you just go nuts.
You're going to go nuts. You're going to tear the skin off on that. That's exactly what we're seeing across prices today. Gold ETFs traded across the region. A lot of the big ones, of course, traded in mainland China were down about 5%, which I guess tells you about how really well structured these ETFs are. The fact that they're trading almost within striking distance of each other, given the drop in the gold price of about 5%. Okay, Pop Mart.
Yeah.
Business update.
Yeah, so we basically saw that big pop in the sales here, 250% year-on-year growth, with sales in overseas markets also surging as well. So that gave another bit of kind of pop for the stock after that correction that we saw yesterday. And Citi was basically saying, yeah, buying opportunity now, 5.5% up for Pop Mart. That's it for us.